Good day, newbies. Welcome to this session of the class by CF Trading Hub. CF Trading Hub is a trading hub for traders and investors of all levels, just like you newbies over here trying to find your full start in the whole financial market. So the financial market is a very large space, and you need thorough guidance in actually navigating through, and that is why you are here, and that is why CF Trading Hub is the best choice for you. So now, in this session, I'll be talking about the fundamentals of trading and financial markets. A practical guide for beginners. Now, I welcome you to the financial trading world. Trading is more than just numbers on a screen. It is is a practical skill that can create opportunities for financial independence, wealth building, and deeper financial literacy. In today's world, millions of people trade in various markets: forex, cryptocurrencies, stocks. We have a lot of markets. Some trade for partial income, others trade for full-time career, and many trade for as a tool for long-term wealth building and wealth creation. Unfortunately, trading is often it is often misunderstood by people. So some people dismiss it as a risky or scam thing, but that is not what trading is. The simple truth is with proper knowledge, discipline, and the right mindset, trading becomes a valuable opportunity rather than a gamble. So what is trading? At its core, trading is the art of buying and selling financial instruments with the aim of making profit from short-term changes in price. So that is all trading is about. Trading is all about buying and selling of financial securities. So just as people buy and sell goods in everyday markets, we have physical markets. So that is just what happens in trading too. So trading is trading. All these markets are they are the financial markets: your cryptocurrency market, your stock market, your forex market. Just like you have a physical market, you have a financial market too. And this is what we do in the financial market. Just that we have a lot of markets in the financial market. All this your stock markets, crypto markets, forex markets, commodities markets, indices markets. You have a lot of markets in the financial market. But what we solely do is in trading is buying and selling of those financial securities in each market. That is what trading is all about. But trading is not only it's not about chasing profits. People also trade for speculation, which is predicting price movements for gain, hedging, protecting investment against risk transfer, shifting exposure from one party to another. So this flexibility makes financial trading one of the most dynamic aspects of modern finance. So trading is not the only thing we do in financial markets. You trade, we speculate, we invest. We do we stake. There's a lot of things we do in the financial market space, but trading is one of the core things, So it makes it one of the most dynamic aspects of the modern finance. So there are a lot of markets you can trade, like I said before. Every market you can trade are the markets in the financial market. So we have we have the number one, the foreign exchange market, which is trading of currency pairs. The forex market, you must have been hearing of the forex market everywhere. It is it is the largest financial market in the world, but it is just one of the financial markets you have. The forex market is not the only thing you can trade. You have a lot of markets you can trade too. So you have pairs like I'm talking about the forex market. It means foreign exchange. You are dealing with currency pairs over here. So you have currency pair you can trade like Euro USD, Euro against US dollar, JB, JPY. That will mean pounds against Japanese yen. So just like that, it is the largest and most liquid financial market in the world. Opens 24 hours a day, and it opens from Monday to Friday. So you also have the cryptocurrencies market, which is digital assets such as Bitcoin and Ethereum over here. We have a lot of cryptocurrency coins when you are familiar with the crypto market, but it's also just a financial market. So you have the stock market where you can trade shares of companies such as Apple, Tesla, Microsoft, and all those markets. So you can trade when you want to trade stock markets. You trade them on stock exchanges during particular hours. So prices are tied to company performance and broader economic conditions. So you also have the commodities market where you can trade commodities like gold, oil, silver, and other agricultural products. You also have the indices market. You have a lot of markets. Now, how does trading works? I studied it initially. Trading is all about all about buying and selling, all about long. Now, there are different names you can call it. When we talk about buying and selling, buying also means you are long in the market. That's just a different name for it. Buying also means you are long in the market, and selling means you are short in the market. So how does trading work? It's all about buying and selling the market, which also means long and short in the market. So When you say long, that means you're buying, which is what it means when you profit when price rises. And when you say short or sell, it means you are profiting what when price is selling. So you have position size. Position size is what is the size of your trade, which determines how much money you gain or lose from each price movement. So position sizing is all about whenever you want to trade, you have to size the position so you know the amount you are risking. By now, I believe before you come into the trading space, you should have known when you want to take a trade, you risk a certain amount of money, which we call it margin, in order to make a certain amount of profit. So position sizing is all about knowing the amount of money you are risking as a margin and knowing the amount of profits you'll be making when you hit your objective. Position sizing is all about knowing everything relating to your position. And when I say a position means a long position or a sell position, which means a trade you are taking. A position means a trade you are taking in the market. Either you are going long or you are going short. Either you are selling the market or you are buying the market. Also, we have leverage, which allows traders to control a larger position with smaller capital. Example, with $100,000 and you have a 10x leverage, you control a $10,000 position. That is just what leverage means. So yeah, leverage in different markets means it actually means the same thing, but it comes in different concepts. Leverage in crypto is just leverage. Leverage in forex is just lot sizes. Leverage in stock market is leverage in stock market is represented by something else too, but that is just what leverage is. Now we have other types too. There are other types everybody must know when you're coming to the market. One of the most basic order and the most common thing you actually hear when it comes to orders in the market is CMP, which is current market price. Now talking about current market price, it means it means the current price the market or a particular asset is trading at. Let's say we are talking about Bitcoin. Bitcoin right now is trading at around probably $90 something thousand. So that is the current market price. So if you are being told you should go long on a position or go short on a position at CMP, it means you are going at current market price without having an order till later. When you say you are setting an order, that will mean you are setting it for later prices, either in long or short. But when you are talking about CMP, that will mean at the current market price. Yeah. So also you have limit order, which is executes only when the market reaches your specified price. That is what I was talking about. That will mean you are setting for a later price. So you have stop loss order too. A stop loss order means whenever you are in a trade, let's say whenever I want to enter a trade, you are risking a certain amount of money to get into a position. You are risking a certain amount of money to get into a position. So a stop loss order means whenever I'm making loss and I make loss to a specified amount or price, I want to cut off my losses. So stop loss, just like the name implies, it stop your losses. And take profit also means whenever you're on a trade, you expect to make profit and you're making profit. Take profit means a specified amount or price where your profit is taken off the trade and the trade is closed. So stop loss and take profit are two essential orders you have to understand. Whenever you are making losses, stop loss is to protect your capital from making a lot of losses. So you have to just specify this the amount of money I want to risk to lose on a trade or the particular price. You set your stop loss there. Whenever your losses are up to that particular price, it cuts off. And take profit too. Whenever your profit reaches that particular price, it takes your profit and close the trade too. They are very, very important because they are automatic orders that triggers even if you are not on the trade. When you set them and price goes there automatically, it triggers. So when you actually go through all these videos finish, you can go through the other videos on the playlist. You actually be able to see practical examples of everything I've been explaining, especially these take profit orders and stop loss orders and how to set them. You'll be able to find it there. Now we also use trailing stop, which is a stop loss that just as price moves in your favor, helping you secure profits while allowing for further gains. When you're on a trade, you can already be in profits before and price decides to reverse. So but when you use a trailing stop, you actually keeping certain amount of profit while the price is moving. That will mean you are trading your stop loss into profit, and when the price reverses to actually tag that stop loss, instead of you being in loss, you'll be in profit already and close in profit. But when you know how to use it practically, you get it better. Now, reading price chart is one of the things you have to understand when coming into the trading space too. Very, very important. So let me just say, candlestick represents what history of price for a particular period of time. I will share this particular PDF into the group, so you can understand it better whilst you watch this particular video. And perhaps I will make a new video on candlestick, so you understand what candlestick is better, or share you some insight on it. Now, a candlestick represents history of price for a particular period of time. It is very, very important to understand what a candlestick is. So candlestick is just price against time. It's just price against time. So whatever price is doing for a particular period of time, a candlestick is what represents it. That is what a candlestick is. Now, charts can be viewed on different time frames, and those are particular candlestick time frames. So we have a lot of time frames ranging from the minute time frame, hourly time frame, daily time frame, monthly time frame. Even we have second time frame if you want to use it. So, but the way we use it when making analysis, we don't just say it as time frames. When making analysis, we use it according to the kind of analysis we want to do. So let's say we are analyzing short term, go for 1 minute, 5 minutes, 15 minutes. So they are a lot more noisy because they are lesser time frames, and they are short term. Medium term, we go for 1 hour and 4 hour time frame, which are clearer short term trends. Long term, we go for daily, weekly. Before you can understand this better, you have to understand what technical analysis is. But this is strictly a fundamental class. At CF Trading Up to we teach technical classes too, but that will be a later case. You can reach to the admin on the group, so you can understand how that goes too. So also, traders also use support and resistance levels, which are price zones where markets repeatedly bounce or reverse. So you must have been saying this before too. So why traders lose money? Most traders fall because they make avoidable mistakes. Using too much leverage, that's a mistake you can avoid. You don't have to use too much leverage. So those are one of the impulses you have to make sure you are not falling into when you become a trader with time. But these are key things that takes time before you build up in your actions. Trading without a stop loss is very, very, very bad. Very bad. Making decisions based on fear or greed. Following hot tips or signals without understanding. Risking too much of the account on a single trade. So these are just some of the reasons why traders lose money. Trading is not gambling, is all about discipline, planning, and consistent decision making. So there are a lot of opportunities in trading, opportunities and risk in trading. The opportunities are it is a flexible income potential when you understand it and you can take it for what it is. Improved financial literacy, compounding returns with discipline. The risk are possible loss of capital, psychological stress, exposure to scams, the danger of overusing leverage. So these are all important things you can do without when you try to do without it. Success comes from balancing opportunity with risk, always protecting capital before chasing profits. Getting started as a beginner, what do you need? If you are watching this video, I'm very sure you must be new to trading. So if you are new to trading, here's a safe path for you to start. Learn the basics. Study guides just like this one. You can go through these basics so you can understand the basics of financial trading and financial market itself. Open a demo account on a reputable platform to practice. You can go on to MT5 and do that, MetaTrader 5. So for you to know how to do this, how to open an MT5, you can just go onto your Play Store, download MT5, then go ahead and navigate it through. They are just simple steps you can go through and create a demo account to actually take 1 or 2 trades. You can go onto your broker, download a broker like Bybit. Bybit offers a demo account too. For you to understand how to log into the Bybit demo account, you can go on YouTube, search for how to log in on the Bybit demo account. So you can understand how to take trades. You can just lose the free money just for your learning purpose. Lose the free money, take trades, practice there. So when you practice there and you are able to familiarize yourself with your platforms, then you can go on from there. So that is a step. So mostly for forex we use MetaTrader 5. So as a forex trader, you can download Meta. If you want to focus on forex trading, you can go on to Play Store, download MetaTrader 5 and use it to practice and familiarize yourself with the platform. If you want to be a crypto trader, crypto trading platforms are almost all the same, so you can but Bybit is the only platform that offers what demo account, so you can download Bybit and use their demo account what to familiarize yourself with what with trading panels for crypto exchanges. So that will help you. Also, number 3, test a simple strategy for at least 30 to 60 days. Before you can test a strategy, you have to learn the strategy. So that is the next process for you after learning these basics. Go live with small capital and strict rules. So that will be after you understand your strategy and test it. So keep a trading journal, very very important. Record your reasons, results and lessons for every trade, and that's how you improve. So this approach builds both skill and discipline without putting your money at unnecessary risk. It's all a gradual procedure. It is a very gradual procedure, and you have to be able to follow it. It's very very important. So how the financial markets works? To trade effectively, you must first understand how financial markets function. At their core, markets are built on the interaction of buyers and sellers. Price moves because of the simple forces of supply and demand. So that is what moves price. When there are more buyers than sellers, price rises. When there are more sellers than buyers, price falls. It's all about demand and supply, just like your basic economics. So when there are sellers in the market starts to fall. When there are buyers in the market starts to rise up. So this principle is the heartbeat of every market, from currencies to stock to commodities, cryptocurrencies, in this any market. Market participants. Now let's talk about the market participants. We have retail traders. Retail traders are just people like you that want they are just influx of people that come into the financial market every day. So they are everyday individuals like students, hobbyists, small investors. The major thing about retail traders are they have relatively small capital in size. So even if you are coming in with $100,000, you are still a trade trader in the grand scheme of things, especially for a market like forex market with a daily trading volume of $7 trillion every day. Sometimes even you are bringing $500,000, you are still a retail trader in the big scheme of things for some markets. So you have institutional traders like banks, hedge funds and proprietary trading firms. So they control huge amount of capital and have the power to move markets. So we also have market makers, entities that provide liquidity by constantly offering to buy and sell. They keep markets active and profitable. So market makers are one of the major participants in the market that causes the movement of the market, that causes the sellers that causes the supplying and demanding, the selling and buying of those charts you are seeing. So you also have brokers and exchanges, which are the platform that connects these traders, just like you and I to the broader financial market itself. So that is what brokers and exchanges do. So brokers are just something like OctaFX for forex. You must have heard of Exness mostly for forex. For crypto, you have heard of Binance, Bybit and all. So those are crypto exchanges too. So now, retail traders are the smallest players, I told you before, whilst institutions and market makers have the largest influence in the market. Now, price charts. Markets are studied through price charts. I've mentioned this before, which visualize how price changes over time. The 3 most common chart types are line charts, bar charts, and candlestick charts. So the content for each chart is written in front of them. Line chart connects closing price into a smooth line. Bar chart shows the open, high, low, and close for each period. Candlestick, which is the most popular, shows market psychology clearly, buyers versus sellers. A candlestick color and size reveal whether buyers or sellers dominated within that time period. Like I told you, a candlestick represents history of price for a particular period of time. So you actually be able to connect this what I just said now to that definition. So long wicks show rejection zones, while where price attempted but failed to break through. So I believe you need more of chart explanation on this aspect, so you'll be able to get it. So I'll just leave it here. So every basics I've been explaining before, and I'll still explain, are just enough for you to understand the basics before you go onto the chart. Now, support and resistance. So this part you actually need a chart to understand what is going on here. But let me just make a quick explanation. Support and resistance are critical zones in the market. A support level is where buyers constantly stopping price from falling further. When price is going down, support levels are where price actually gets supported and starts rising back after some amount of fall. So resistance are just they are just opposite of it. A price level where sellers dominate. When price is going up, resistance level is a level where sellers they resist price from going further up and they sell price off. So you have to get onto the chart to actually what to actually understand more of this. So market moves what? The market moves in waves. Price or not does not move in what? In straight lines. Instead, it flows in what? It flows in waves. It flows in waves. If you've seen it as a newbie, you must have seen a price chart before. When you see a price chart, you can see a price chart doesn't just move in one straight line, just going up or just coming down, just like that. They move in waves. Especially when you see a what? When you see a healthy market. Especially when you see a healthy market, it moves in what? It moves in waves, not just what? Not just in a single straight line. So we have impulse waves and we have corrective waves. So strong movement in the direction of a trend is what? Is an impulse wave, while corrective moves, which are pullbacks or retracement before trend resumes, either what? They are correction or corrective waves. So you have to get onto the charts and understand technical analysis to actually be able to get this part. Yeah, this rhythm is natural, just like breathing in and out. Learning to recognize these phases helps traders identify entries and exits more accurately. So liquidity refers to how easily an asset can be bought or sold without causing drastic price changes. So there are a lot of markets, and like I said, high liquidity forex is highly liquid, which means spreads and stable moves. Low liquidity cryptocurrencies are what? Have low liquidity compared to what? Compared to forex market and stock market. The two largest markets are what? The forex market and the stock market are the two largest markets in the financial market. But these are technical concepts I don't think I will be able to understand from this explanation. So let me just go next. Key fundamentals every trader must know. Successful trading is less about chasing quick profits and more about building what? A solid foundation. There are a few pillars that every trader must master. So trading is just not about you coming into the market, I want to chase a quick profit, I want to do this, I want to just make money. You have to understand it is not just about making the profit. It's far more than making the profit. If you don't understand this, or you just think it's just about making a profit, you are what? You are likely to what? To lose more, or you are likely to what? To fail at this more than you are likely to succeed at it. So you have to follow the gradual process, follow the procedures. So now risk management. That's number one of the rules. This is the single most important rule in trading. It's a rule that sits above what? Above all other rules. Without it, even the best strategy, it fails without proper risk management. So never risk more than 1 to 2% of your account on any single trade. Yourself as a newbie, this is the number one rule for you. Even when you're managing a demo account, you should still follow the particular rule. So and also always use a stop loss. A stop loss is part of what? It's part of risk management rules. So you understand it. Focus on risk to reward ratios, e.g. risking $10 to gain $30 is good. Yeah, risking $50 to gain $20 is poor. How can you risk $50 to actually gain $20? That's nonsense. But when you risk $10 to gain $30, that's making sense, because you are risking to gain let's say 200% of your of your margin, or 2 times of your margin, which is great. So an example, if your account is $500 and you risk 2% per trade, your maximum loss should be $10. If your stop loss is 50 pips away, you calculate your position size to ensure that a 50 pip move equals a $10 loss. So these are position sizing calculation. So you actually don't know this yet until you learn technicals first, then you start trying to take trades and how to trade. There are a lot of process to this. You have to learn how to trade too, which I believe for crypto is already on the playlist. But for forex, I will drop it soon with time, so you actually be able to go through that too. Now number 2 is trading psychology, and among the fundamentals every trader must know. Your mindset is as important as your strategy in trading. Emotions often destroy traders before lack of knowledge does. Fear and greed cause irrational decisions. Discipline means sticking to your plan. Patience means waiting for your quality setups instead of forcing trades. Resilience means accepting losses as part of the journey. We have a lot more on trading psychology than this, but this is the fear I can just put into this PDF, so you can just get some insight into it. But we have a lot of trading psychology but everything is actually when you actually join the community, you can go through your process from there. Now, essential tools you need. Every trader needs basic set of tools. You have to have your broker or exchange. I told you have to have a broker or an exchange. The broker connects us what? Connects the trader to the financial market. So it is impossible for you to trade the financial market without what? Without needing the broker. That is why I said you should go and download your Bybit at least to try out the demo. But there are a lot of brokers and exchanges out there. So brokers are majorly what? In stock market, it is called stockbroker, which is what? They are the brokers. In forex, they are also the brokers. In commodities, they are also the brokers. In crypto, it is mostly called what? It is mostly called exchanges. But mind you, the meaning of broker and the meaning of exchange in context to the financial market is what? It's the same thing. They both connect the trader to the what? To the financial market. That's it. Now, also, your charting software like your TradingView for analyzing price action. So as a trader, you want to learn how to make analysis as a trader. That's what you want to do. How to do analysis, you have to learn a strategy, how to analyze the charts. So after analyzing, how do you analyze yourself? You have to have a charting software, which is what? Your TradingView. Very, very important. So when you learn, that's where you practice and that's where you analyze going further. You have to have your economic calendar to track important news and events that moves the market is also very important. Trading journal to log trade, study mistake and track progress is also important. So you have to have a trading checklist too. Before you trade with real money, make sure you have done this. You have understand and applied risk management. I mentioned it earlier. Practice first on a demo account. I mentioned it too. That's why I told you to go ahead and download your Bybit to actually practice on a demo account there. And for forex traders, go ahead and download MetaTrader 5 to actually practice on a demo account there. And you have to be able to control your emotions. Very, very important. Though mind you, until you go live with the capital, you won't know how to control your emotions. But try as much as possible to actually put it in your mind to actually be able to control your emotions. So when you get onto your live capital, it becomes easier. Not that it becomes easier, but at least you get an insight into what you are doing before you go there. So very, very important. So you have to be using your basic trading tools like your charting software, which is TradingView already. Trade with a clear and tested plan. Not just trade anyhow. When you want to trade, you have to make a clear and tested plan. Have a strategy, a working strategy that you've tested over time. After the working strategy, make sure you've traded with the demo account and see your what, and see if you are going well or not. After that, the next plan for you is doing what? Going live. But before you go live, have a plan. Okay, this is the amount of capital you are trying to allocate. What is your 1 to 2% risk before you go in? How do you plan to scale it up over time? You have to have a clear trading plan. This is also what? Very, very important. So if these fundamentals are missing, you are gambling, you are not trading. So there is a very thin line difference between gambling and trading. So you can be gambling sometimes and think you are trading. So you have to be very, very careful of that. So institutional versus retail traders. One of the most important distinctions in trading is between retail traders and institutional traders. Understanding this difference can change how you view the market. Retail traders are individuals like students, small investors, or part-time hobbyists. They usually trade small amounts, rely heavily on indicators, signals, or social media tips, react emotionally to price movement, often chase the market rather than anticipate it. I believe by everything you've heard just now, you will see yourself as a regular retail trader, because you know this is just what every random regular retail trader does everywhere. So that is a retail trader. Institutional traders include banks, hedge funds, asset managers, and proprietary trading firms. They trade with huge capital, often in billions of dollars. Use advanced strategies, algorithm, and data, influence markets through their large orders, think long term, planning weeks or months ahead. So they are way different from retail traders. Because of their size and patience, institutions often create traps for retail traders. So they make they take them as collateral for their position. And there is always a large influx of retail traders that comes into the market every day. So it is just like smart money versus dumb money. Dumb money is just a large influx of traders that comes into the market every day. And smart money put themselves in place to actually collect the dumb money, collect liquidity from the dumb money. But when you understand it from the technical perspective, it gets clearer. So that is just what you need to know for now. Smart money are institutions and professional firms that shape the market. Dumb money are retail traders who follow trends blindly without understanding the bigger picture. So that's just the main difference between the two. For example, when retail traders see a breakout, they may buy in, but institutions sometimes push the price slightly higher. These are technical concepts you understand, so let me not even digress into it. And why this matters: most beginners lose because they trade like retail. To succeed, you must learn to take like institutions. So, and that's the kind of strategy we actually teach as CF Trading Hub. So we actually what you actually follow strategies that institutional like with institutional footprints. So you actually what you actually move as much as possible in line with the institution and not what and not with the retail money, or not retail not with the retail mindset of traders. So and that is what gives you high hedge in in trading. It gives you the higher edge in trading, and this is very important. So most beginners lose because they trade like retail, which you shouldn't be doing that. Actually, to succeed, you must learn to think like institutions, study price actions and liquidity zones, be patient and disciplined, avoid emotional and reactionary trading, focus on capital preservation first. Very important. Capital is always is one of the most important key in when it comes to trading. The goal is not to compete with institutions directly, but to align with their behavior. So I've said enough for you to actually grasp the basics of financial trading. You actually be able to grasp enough. So you might not understand some into key deep, like one of the few chart I mentioned there, like the practical example of you trading on a trading panel. But when you actually familiarize yourself with it with time, and you ask questions in the community group, you actually are able to go on with time, effectively with time. So I will expect you to actually make comments or ask questions whenever you don't understand anything. And at TF Trading Hub, we are always here for you to actually keep your growth intact and steady. That's what we are here for you for.